If you're in Seattle, and you need to buy or sell a home, we'll be right there for you. Because we're the realtors that you can trust. So go to ronanddonsitdown.com.
You're listening to The Ron and Don Show on the Ron and Don Radio Network.
Hey everybody, welcome back to the Ron and Don Show. It's our real estate only special, and as you can see, Don's got a lot better looking between this show and the last show. This is Lysa with a Y from Team Lysa at Origin Point Lending. And Lysa, thanks for coming into the studio.
Of course, good morning.
So here, what we're going to do right now is talk a little bit about mortgages. We're going to talk about interest rates. We're going to talk about stuff. Don and I get these questions all the time, refinancing, etc. But to start things out, and this to me should be common knowledge, but it's not with people. Most people think, oh, I want to buy a house, I'm going to go to the bank. And then many people go to the bank and are like, that was disappointing. I didn't qualify for anything at the bank. A mortgage is a product, just like any other product. Can you just tell us real briefly the difference between a mortgage broker and going to a bank and sort of the limited offerings that you find there?
Yeah, absolutely. So a bank doesn't specialize in mortgage. They specialize in, handling your checking accounts and your investments. If you go to someone like myself, we specialize in mortgage. So rather than putting you in one box, we're able to sit down, look at your situation, talk with you, find out what your goals are. And then we have more, loan programs and different options that we can provide to you.
And would it be fair to say that I should think, like when I went to buy my new car a couple of years ago, I went and I looked at 3 different models and I sort of compared all the features and then I landed on the one I was going to buy. Should I think about loans in the same way that they're different products?
Absolutely. There's no one size fits all in mortgage. And I get frustrated when people think that, because oftentimes when I sit down with people, they have so many more options than they think they do. Whether they want to put 5% down instead of 20% down, whether they want to buy their next home before they sell their current home. There's a lot of mortgage programs tailored to meet those needs. And oftentimes people aren't aware of their options.
And so I don't want to bang on banks, but in my experience with a bank, if you've been with a bank for a long time and you fit exactly within their box, it can be a great product. But if your one little toe is sticking out of the box and it's like, well, no, we're not going to lend to you. Is that fair to say?
Yeah, absolutely. I think that that's fair. And oftentimes, refinancing with your bank when you've got all the time in the world, that can work. But when you're looking to buy a home and you're either trying to negotiate with a seller or competing with another offer, the bank's not going to be able to move quick enough. They're not going to answer on the weekends. They're not going to put together that personal underwritten pre-approval. They're not going to call the listing agent and help position you to win.
All right, she's Team Lysa with a Y. That's at teamlysa.com. Let's talk about interest rates. Everybody seems to obsess about interest rates.
All the time.
What do you think are the biggest couple misconceptions that the general public has about interest rates?
That is a tough question. I mean, everybody's always talking about interest rates. And right now, I think the news is really reactionary. Interest rates are up, interest rates are down. But what I think it's important to note is that we are moving in a very narrow band, right? We're literally going up or down about 0.2 or 0.3%. If you look at us historically, we're over 1% lower than we were a year ago. Mm-hmm. That increases buying power by over 10%. Psychologically, under 6% seems to be a big, motivator for a lot of people. And every time we fall below 6%, you see the buyers re-enter the market and surge. We hit that level 2 Fridays ago. That was the lowest we'd seen in 3 years since 2022. And we saw a surge in buyer activity. Right now, we're hovering right above 6%. And I think we're going to kind of continue to move in that range in the near term.
Do you think that people make it a bigger deal than it needs to be, or it's appropriately sized, or that they underestimate the difference between 6.01 and 5.98?
That's a great question. Now, I think interest rates are a huge factor right now because affordability is a factor, right? And we're double where we were, at the beginning of 2022. So I think we have to look at interest rates. Mortgage loans and the products that we offer change depending on what's going on in the market. And oftentimes now we're doing temporary buy downs, we're doing 40-year amortization and other things to keep the payment affordable for people. But in terms of day-to-day movement, if the interest rate goes up 0.1 or goes down 0.1, that's not going to make or break most people's budgets. And, they're looking longer term to get into the house that they want at the price that they can afford to buy. And they might refinance in 6, 12, 18, 24 months.
So before we go on to refinancing, you brought up a couple things that I think a lot of people won't understand. So let's talk about when monthly payment is your biggest driver. So a lot of people are like, hey, I can only spend $3,000 a month or fill in the blank, $3,500 a month. And so the first one you brought up is a temporary interest rate buy down. So we just did a deal together with a female client that bought a townhouse, and we bought down the loan, the maximum amount, but it was the seller that paid for that. Explain what that means to your monthly payment, because there's a couple of moving pieces here.
Yeah, absolutely. So you're referring to what we call as a temporary rate buy down. Those are actually my favorite programs on the market right now. We did a ton of them back in 2010 and 2011. And then when rates were around 3% for a decade, we didn't do them, but they're back again. And the way that they work, they are funded by a seller credit towards a buyer's closing costs.
So let's do a example that you just said. I get a loan, I'm approved at 6%. And then we say, Lysa, the seller's willing to buy this down. What happens next?
Yeah, absolutely. So if the seller's willing to give 2% of the purchase price, so in your example, $12,000, towards a buyer's closing costs. Now, keep in mind, in King County last year, almost 70% of the contracts had some kind of seller concession towards closing costs. So this is something that could be negotiated. With that 2%, we have two different ways we could use it, really three. One would be to pay a point permanently. So you as the buyer pay an additional fee at closing and you buy that interest rate down for the life of the loan.
And so let me explain. This is basically we're prepaying the interest to the lender.
Yep.
So we're saying we're going to give you this interest would have happened month over month over month. Instead of that, we're going to give it to you up front. So the lender still gets paid.
Lender still gets paid up front, and that's going to save you. If interest rates are like at 6.25%, that might take you to 6%. There's another product
and
called,
what would that do to your monthly payment?
Depends on your loan amount, but it's going to move the needle a little bit,
okay,
of course, but not as much as one would think. Now, if you do a temporary rate buy down, you're going to take that same 2% seller credit. It will buy your interest rate down 2% for the first year. So that's going to take you from 6% to 4%.
That's a big deal.
That's a huge deal. Now you're really moving the needle. Year two, you're going to go from 6% to 5%.
And then let me just say real quick, if I keep interrupting you, but in terms of monthly payment, I've seen monthly payments drop by $1,200, $1,500 a month with those 2 points.
Exactly. So that's really
maybe more.
Exactly. That's really making a difference. And then on year 3 through 30, you would convert back to that regular 6%. There's no prepayment penalties on these loans. And what's fantastic about them is if you refinance in the first 2 years, which the goal is, you hope that you will do that, you have leftover seller credit and you don't lose that. It gets applied towards your principal as a principal reduction.
So that's the interest rate buy down. Thank you for saying that, because a lot of times we think, oh, everyone knows what that means. And basically you're taking your monthly payment, and depending on the program, it can drop significantly. So that's something that Lysa can do, Lysa with a Y, can do. And
I'm having PTSD from elementary school right now.
So let's talk about the other one real quick, and then we'll get to refinance.
Okay.
And that was, we'll make your loan longer. That makes your monthly payment lower.
Yes. So what you're referring to is a 40-year amortization. So instead of scheduling, taking the full loan amount and spreading it out over 30 years, we can do that over 40 years. And we do that quite often because people like it. They still get that same security of the same interest rate. There's no prepayment penalty. Their payment's not going to change, but they're only obligated to that lower payment since it's stretched out for 40 years. Now, a couple thoughts thoughts with that. One, you can still make the 30-year payment or any other payment that you want if you want to pay more. But psychologically, it can feel better to have that lower payment, especially if maybe you're looking to have another child or some, expenses coming up. And the other thing that I'm always surprised about is, let's say you do a 40-year loan now and you want to refinance in 6 or 8 months. You can refinance to a 30-year or vice versa. Whatever loan you take out up front, you're not locked into that when you refinance.
And the other thing that popped into my mind is, how long does the typical person stay in their house anyway?
Oh boy, that's actually starting to go back up a little bit. I don't know if you saw some of the news, but in general, it's about 5 to 7 years.
Yeah, so most people, the vast majority, are not going to be there in 40 years.
No.
So if the most important thing to you is a monthly payment, that could be another way to get there. Okay, so let's talk refinance.
Okay, let's do it.
And so if I bought a house at the peak when it was 7 point whatever,
yeah,
and now I'm going, God, that was so dumb. My interest rate is too high. How do I know when is the right time to refinance?
Yeah, that's a question we get all the time. And you can never time the market, right? Everybody always wants the lowest rate. And you know what? Nobody knows. We usually don't know it was the lowest rate until it's gone. But in general, there's some benchmarks that we look at. So if you plan to stay in your home for 2 years and you can save 0.5% or more, then it's generally worth a refinance. Sometimes a little bit less time if the lender's willing to pay the cost.
So if I was 7.5 and it's at 6 now, that's a good time to start calling Team Lysa with a Y.
That's a great time to call Team Lysa with a Y.
Okay. And so how do you think about that in terms of how long it's going to take me to recapture the refinance process?
Yes, that's a perfect question. So basically, you want to look at how much is that going to cost you and how much does it save you each month. So if it costs $2,000 and it saves $100 a month, well, then you need to stay in your home for 20 months to make that worth your while.
Okay, so there's two things that I think about there. Number one is you can significantly reduce your monthly payment. So in the example I gave, if we went from 7.5 to 6, your monthly payment's going down a lot. If you can refinance there. But refinancing isn't free, except are there instances when the fees might be able to, if I did a loan with you and in 2 years I do another loan with you, can we maybe not do every single fee on the docket?
Yes, of course. We'll take care of you. But most lenders, and we offer a no-cost refinance for our clients once they've made 6 or more payments. So we would absolutely cover the costs. I do think it's important, and I feel the need. I'm a mom, so I always want to tell the downside to everything. It's great for me if you refinance every 6 or 8 months. I will do that for you until I retire. But every time we refinance you, we are resetting your amortization schedule. So if you had a 30-year loan and you've paid down 3 years, you're going back to 30 years. Mm-hmm. So there's always some strategy involved. Any good lender, myself and my team included, we'll sit down with somebody, we'll analyze their numbers, we'll make a recommendation. So 0.5% or more, yes, but you don't necessarily want to refi.
So rule of thumb, if I heard you right, if rates are 0.5 point lower than when you took out your loans and you're going to be there for at least 2 more years, to give you a call or reach out to teamlysa.com.
Yes.
Okay. All right. So one thing that Don and I deal with all the time, and I hope you can clear this up, is what is the difference between going on a website or an app and that app saying you're pre-approved versus calling Team Lysa with a Y and going, okay, we've gone through your file and you are underwritten.
Yes.
What's the difference with those two things?
So there's actually a pretty big difference, and I'm not sure most people realize that. So I've been lending for 27 years. I should round down, shouldn't I?
Exactly. For 19 years.
Over 20. But essentially, when you go online and you put in some basic information, you've done what we call a pre-qualification. You really haven't done much. You've probably got a soft credit pull, a quick look online. Yes, things look good, but you have not been through the full process. So when you go to make an offer and you go into contract, now the process is going to begin. That lender will be asking for your documentation. Everything has to be sent to an underwriter who's an actual person who's going to look at all your documentation and make sure that it matches.
The underwriter, just if people don't know the lingo, they're the person saying, how risky is Ron? How risky of a person is he to give a lot of money, give hundreds of thousands or millions of dollars to?
Absolutely. And a lot of surprises can come up, right? Because you're not a lender. So
and they do.
Well, the average person, they don't deal in lending. So when they're filling out their application online, they think they're answering the question correctly, but they don't know. And so they can get into the underwriting process. There's trouble that can come up, and they might have their earnest money at risk, which can be a very scary place to be versus working with someone like myself. We are going to take that client further through the process up front. We're going to look at their credit, their income, their assets, their employment. We're going to underwrite that loan. So then when they go to find a house and make an offer, they can do that with confidence. Keep in mind too, a lot of times when there's a good house, we still see multiple offers. And if you're competing against someone else and you have to offer a quick close or potentially waive your financing, or your earnest money's at risk. So you want to know with confidence that you've been fully vetted and through the process.
Tell people this part. It can be a little bit of a pain in the butt. Like you got to get your...
It's so fun.
You got to get your tax returns. You got to get your W-2s. You got to give them pay stubs. You got to give them all your bank accounts. And then there's a bunch of questions. You got to fill out this form. And so that part is a little bit painful. But once you do that, can it just easily be refreshed if maybe I'm looking for a house for months and months?
Yes, it can. So typically that's good for 90 days. It's very easy to keep that refreshed, to use your word. We say open and active, just by getting updated pay stubs and bank statements. But part of our goal is to meet with you early in the process so you really understand what your goals are, what your budget is. And when you find that right house, it's overwhelming. You everything's going through your mind. You're doing an inspection. The escrow company's reaching out. They want your earnest money deposit. You're trying to plan moving. There's so much on your plate.
Will my couch fit? Whose room is whom?
Yeah, exactly. The kids are fighting over what room they get, or at least mine would be.
Right.
So we try to really front load the process so that when you get to that point, I like to say the financing should be anticlimactic, right? You should be focused on yourself, your family, what you're doing, and we're going to make that as easy as possible.
And I got to say, Don and I, as listing agents, when we're selling a house, if we get multiple offers in on a house, one of them, even if it's a little bit lower than the other offer, but they're underwritten, and this other offer comes in with just like a generic, you're pre-approved. It's like, that's not worth the paper it's written on. And so if someone's fully underwritten, all their docs are in, many times we will say to our sellers, you might consider this offer because this one's going to close. I have no idea if this other one's going to close. Like, these folks haven't even started yet.
Yes. And as a listing agent, you can get a hold of us. We're going to pick up the phone. We're going to answer. We're going to let you know where we are in the process. It's a risk for the seller to take your offer. They don't want to take their property off the market, risk that valuable time. So if they do, they really do want to know you're a solid buyer.
And so last thing, and this is what I love about your company, why Don and I love working, one of the reasons we love working with you, is you mentioned the weekend. So I'll give you a scenario. It's a Saturday. Someone was underwritten for $750,000. They're out and about. They see a house that's actually $825,000. And so they're like, "But we're not approved for $825,000. With your office, you guys are open on the weekends. We can call you and say, Lysa, Matt off the mic wants to go a little bit higher. Is he able to do that?
Absolutely.
And you guys will answer the phone on the Saturday so that we can get into line."
Yes. And that can make a huge difference too, right?
Yeah, absolutely. So she is Team Lysa with a Y. If you have a loan and it's a 0.5% lower, just pull out your statement. The interest rate is on the statement. Go, oh wow, I'm 3/4 of a point, or I'm a full point lower than we refinance. If you don't plan to move, where can they find you? Where can they reach out? Where can they talk about the refinance process?
I think the easiest is just to send us an email. It's Lysa with a Y at teamlysa.com. But we can set up a time to talk. If you send us a copy of your mortgage statement, we can run numbers for you. I'm happy to sit down and kind of talk through your options.
And then if someone's a buyer, you have so many programs. It can be, a buyer, it can be an investment property, it can be percentage down, you can do FHA and VA, there's many, 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 many products.
That's an understatement. So we're a division of Guaranteed Rate. We are the number one purchase money lender in the country. So we help more families buy homes every year than any other company. So yes, we can do conforming. We are VA, FHA direct. We can close a VA loan in 20 days, which is a huge competitive advantage. Yep.
That is unheard of.
And we're the number one jumbo lender, and we're actually the number one non-QM lender. When you asked me earlier about what's the most common misconception, I don't think people realize how complicated lending can be. You know, before the credit crisis, we kind of all had the same tools in the toolbox. That's changed dramatically. Non-QM lending is the fastest growing segment in the market, and people don't know what it means. It stands for non-qualified mortgage, but to not get technical, it's really make sense lending. Asset-based loans, buy before you sell, loans for an investment property based on the investment income.
Someone's not a W-2 employee.
Exactly. Bank statements, all of that. So we do a lot of those types of loans.
Well, thank you for coming in today. Again, you can reach out to her. It's teamlysawithany.com, or the email is lysawithany@teamlysa.com.
Thank you so much.
Thanks.
Well, that's it. Show's over. We'll see you next time on the Ron and Don Radio Network.